Hey everyone, this is Ronak Ahuja. I welcome you all again. In this video of today, we'll be discussing the taxability of the immovable property, that is land, building or both for the financial year 2025-26. In case you want to know the taxability of immovable property for the financial year 2024-25 or the tax year 26-27, please look for the link in the comment section. There you'll find the link to the videos for those years. Now without wasting any further time, let's quickly begin. Now before we discuss the taxability of immovable property for the financial year 25-26, let's quickly brush up the amendment of financial year 24-25. The holding period in case of certain capital assets was reduced from 36 months to 24 months in the financial year 24-25. This means in order to take the benefit of long-term capital gains tax rates, an asset was required to be held for 36 months prior to the amendment date. However, after the amendment, the requirement of holding the capital asset was reduced to 24 months. Now, what's the impact on the immovable properties taxability? The answer would be there was no change in the taxability of immovable property because the holding period for the immovable property was 24 months prior to the amendment date also. So this means there was no change in the taxability of immovable property. Now what does this mean? This means in case any immovable property is sold after 24 months from the date of its purchase, then any profits or gains that arise from such sale would be treated as long-term capital gain. And in case the immovable property is sold within 24 months from the date of its purchase, then such gains would be treated as short-term capital gain. Now that we know the difference between the short-term capital gain and the long-term capital gain, let's quickly move on to the tax rates that would be applicable on such gains. This is covered in our next segment. Now, the tax rate that would be applicable on the short-term capital gain on sale of immovable property, that is, when the immovable property is sold within 24 months from the date of its purchase, the tax rates in such a case would be the normal tax slab rates. This means in case of individuals, if the individual opts to pay tax as per the old tax regime, then the tax rates of the old tax regime would be applicable. And in case it opts to pay the taxes as per the new tax regime, then the new tax rates would be applicable. This means the choice is left to the individual itself. If the individual chooses to opt for the old tax regime, he pays taxes as per that. In case the new tax regime, he pays taxes as per new tax regime. However, the case is a little different in case of corporates. In case of corporates, the normal tax slab rates could be 15%, 22%, 25% or 30%, depending upon which concessional rate of tax the company chooses to opt for. Say for example, if the company opts to pay taxes as per section 115BAA, then in such a case, the tax rate that would be payable would be the 22% rate, provided the company satisfies all the conditions mentioned in that section. So, the short-term capital gains are taxed at normal tax slab rates, and these rates depend upon the type of the assessee who is being taxed. Now, how do we calculate the short-term capital gain? The short-term capital gain is calculated by reducing the expenses from the sales consideration, which means the sales price that we get while selling the immovable property. From this sales price, the cost of purchase is reduced. Further, we also reduce the cost of improvements, that is, the cost of major repairs. Further, we also reduce the expenses that we incur on the sale of such immovable property, such as brokerage or lawyer's fees. Now, The resultant figure that we arrive at after deducting all the expenses from the sales price is called the short-term capital gain. And this short-term capital gain is taxed at normal tax slab rates. So this is how we calculate the gains on short-term capital gain. Now let's quickly move on to the long-term capital gain. Now, in case of long-term capital gain, that is where the immovable property such as land, building or both is sold after 24 months from the date of its purchase, then the capital gains tax rate that would be applicable would be 12.5%. However, that would be without the indexation benefit. Yes, you heard that right. There would be no indexation benefit available in such reduced tax rate. However, there is one exception to it. Now, what is that exemption? In case the taxpayer who has sold the property is a resident individual or an HUF and such property had been purchased before the 23rd of July 2024, then in such a case, the tax would be calculated as follows. Firstly, the tax would be calculated at the rate 20% while giving the indexation benefit. Let's call this case as step 1. In the second step, we would be calculating the long-term capital gains as per 12.5% tax rate without giving the indexation benefit. Now, in case the taxes arrived at in step 2 are greater than the taxes calculated in step 1, then in such a case, the excess tax that has been calculated will be waived off. This means the individual or the taxpayer would not be required to pay such excess amount of tax. Yes, this is the exception that is applicable to the individual resident or HUF. Only if the property was purchased prior to the 23rd of July 2024. Now, let's quickly see how we calculate taxes as per long-term capital gain. First of all, in step 1, we calculate the sales price or the sales value of the property that is being sold. From the sales price, we reduce the following expenses. Firstly, it's the indexed cost of acquisition. That is the purchase price after giving the indexation benefit. Then, we reduce the indexed cost of improvements, which is the cost of major repairs that have been conducted. Further, we also reduce the transfer expenses. The resultant figure that we arrive at is called the long-term capital gain with the indexation benefit. And on this, 20% tax rate would be applicable. Now, we move on to step 2. Here again, we'll be calculating the sales value. From here again, we'll be reducing some expenses, and that would be the cost of acquisition and the cost of improvements. One thing to note here is that we are not providing the indexation benefit here. We simply deduct the actual purchase price and the actual cost of improvements. Further, we also reduce the transfer expenses here. And the resultant figure that we arrive at is called the long-term capital gains without the indexation benefit. On this, the tax rate that would be applicable would be 12.5%. So this is how we calculate the long-term capital gains. Now, we quickly move on to the summary. So this was all about the taxability of immovable property for the financial year 25-26. The returns for which are due for filing this July 2026. Now, in case you want to know about the taxability for financial year 24-25 or the tax year 26-27, do have a look at the comment section. The link to those videos are given there. Do watch those as well. Now, in case you couldn't understand any part of the video, or you have a feedback for us, do mention that in the comment section or write us a mail at talklevies@gmail.com. Thank you and stay tuned for more videos.